Good afternoon, everyone. This is Stanley Okoro, your host for the ANPA financial webinar. This is our 22nd webinar since 2020. Today we have an interesting topic. The topic today is life insurance, not death insurance, but life insurance. That's the difference. The ultimate investment. Today we have back again with us, Enyi Kalu. He's going to share with us some of the benefits of life insurance as an asset. Susan is unable to join us. She's traveling today. But I'm just going to be the only moderator today. My partner is not here. But we also have our ANPA National President, Dr. Chris Okunseri, on the phone. He's just going to talk about what ANPA is and go from there. Chris.
Hey, Stanley, thanks once again and welcome everybody to this financial webinar. As we are all very much aware, our organization, ANPA, is a 501c3 organization. We basically represent over 4,000 dentists and physicians in the Americas here. And we continue to engage in activities that actually bring value to our membership. One of which is this financial webinar we're enjoying, which again, we have professional development through our annual meeting. We have a leadership opportunity again through the organization. And we also have the opportunity to get engaged in practice network, practice referrals, networking amongst ourselves, and once again to also support each other in one way or another. And pretty much our signature event, the medical mission, and now we have added the telemedicine to our portfolio, which quite honestly is going to go a long way for our organization. So once again, on behalf of the executive committee of ANPA, I want to welcome you all and continue to thank Stanley, but most especially Mr. Enyi Kalu, who have been so supportive of us in the last how many years that I just can't count, but I give you thanks on behalf of the ESCO, Mr. Enyi Kalu. Thank you very much for all the support you have provided to ANPA.
Okay. Thank you very much, Dr. Okunseri. Today's webinar is being brought to you and sponsored by ANPA and ANPA Foundation.
Don't worry, what happened was that
I was
invite today. In fact, I thought I had missed it. It's a
all right, so sorry about that, guys. So Susan is not here to talk about the membership, but there's several ways to get connected with ANPA through Instagram at ANPA_national, or Facebook or Twitter. If you need more information, you can write to membership@anpa.org, or you can visit the website at anpa.org. By the way, next week we have our upcoming ANPA National Convention in Charlotte, North Carolina, and I think you can register and attend the conference. Okay, so the ANPA financial webinar disclaimer states that the materials presented at all the webinar is for general educational information purposes only, and is solely the opinion of the presenter. No webinar is intended to provide personalized financial or legal advice. It is left to your discretion and judgment, and it's your sole responsibility to determine what's necessary for your own consumption or your practice. Neither the speaker or ANPA can be held responsible for the materials, opinions, and inadvertent error or omissions in the presentation or preparation of the material. Furthermore, nothing in the material should be construed as an endorsement by ANPA. So today, our presenter is well known to us by now. Enyi has been with ANPA for a few years, but the last 2 years he's really supported us through this pandemic, and since the launch of this webinar. The webinar was launched March of 2020 in the height of the pandemic. And this is our 22nd webinars in the last 2 years. So Enyi, this is Enyi Kalu. Enyi is an MBA and is CFF. He's the founder and chief investment officer of Kalu Asset Management Wealth RX Advisor Network. Enyi. Enyi, I think you're muted. Everybody was muted. Let me unmute you. Hold on. Ask for mute.
There we go.
Okay.
Well, thank you again, Stanley. Good evening, good afternoon, everyone, and welcome to another in the series of educational guidance and information that ANPA, under the sponsorship of ANPA, we continue to share with you. If you have attended any of the previous webinars, you pretty much have at least some perspective or some understanding of, who we are as a firm and how we interact with our clients. Stanley, go on to the next slides, if you will, please. I'm sure you know that we work with healthcare professionals. You, the doctors, the dentists, medical professionals in all fields and so on, and business owners and retirees and pre-retirees. We do have a physician or healthcare professional specialty practice, which is primarily focused on providing solutions to those of you in healthcare. Next slide, please. This is our constant differentiator and reframe. We are a team-based group. Michael Jordan, I talk about, arguably one of the best in basketball, could never beat the Detroit Pistons until he had the right kind of team around him. That's how we differentiate. Go to the next slide, if you will, please. What we have aggregated at Wealth RX for Doctors, Wealth RX Advisor Network is an all-star team. If you know anything about basketball, I'm sure you know about LeBron, about Michael Jordan, about the rest of the folk, and so on. And what we do and how we differentiate is by being proactive and holistic. We run a multi-family office providing distinct services in tax planning, risk mitigation, wealth management and concierge, legal services, and business advisory services. You really want a team that coordinates and orchestrates these things on your behalf, and that's what we try to do. It's a one-stop shop for you. You could engage in any of the areas and then get the benefit of all the others as your situation evolves. Next slide, please. So basically, in a family office, you are essentially in an ecosystem of expertise, like I said earlier. And all we want you to do in giving us trust and confidence, or whoever it is you do, just make sure that it is holistic and make sure that they're integrated, everything works together. For us, we basically kind of talk about transformation, and the transformation is powered by trust. Trusting our mission, trusting our focus, and trusting our solutions. You'll find those things in how we interact with you in all of these echoes in our system. Next slide, please. It's the same thing here. You can engage, whether it's on the wealth side, on the tax side, on the multi-generational planning side, and so on. But you come into the ecosystem and you get the benefit of this boutique firm of firms and all that kind of stuff. Next slide, please. I want to start this presentation by bringing to light a webinar we gave a few months ago. That webinar was titled Danger Ahead. Danger Ahead, Protecting Your Assets in a Treacherous Investment Environment. I just thought I'd summarize a portion of that because I think it sets the stage for the conversation around the topic this evening. If you have not been paying attention to what's been happening with regard to prices, then I think you're making some mistakes. If you've not been paying attention to what's happening with your investments, I think you'll be shocked. If you have not been paying attention to the, cost of fuel and other goods and things like that, I think you are probably in some land. I don't want to call it la la land. So my friends, the reality is there's a change in the climate that we're in at this point. And most people are very familiar with the bull market that we've experienced over the last several years. The investment climate today has changed. And what I want to do very quickly is kind of share with you what has changed. Because over the last 10 plus years, between 10, 13, 14 years, we've really been in an environment that's been extremely constructive. And so everybody has taken for granted that the stock market always goes up. So here's what we've had, and I want to kind of share this with you so you can have a perspective on this. They're usually different cycles, or what we call cases, as far as the investment climate is concerned. And the things that determine those things are earnings, inflation, interest rate, and the prices of goods and services. Now, there's a saying in Nigeria that anything that eats grows. In Igbo, they say, "Onye eri nri na-eto eto." That's akin to earnings. Earnings is the food that drives the growth of companies, stock prices, those kinds of things. Inflation, as you know, is essentially the cost of goods and services. Interest rates is dictated by the feds and things like that, and then prices kind of follow as a culmination of these things intersecting with each other. So in a bull market, in the beginning of a bull market, we call that a case one. Usually earnings are going up because everything is constructive. There's no inflation, but it's going to be tempered, but up a little bit. Interest rates are very constructive, they're down. And prices, therefore, will be going up. So if you look at a bull market scenario where a bull market is beginning, you're going to have earnings going up. Inflation would still be up, but trending down. Interest rates would be lower because of the Fed's working to bring down, kind of help fire things up, so to speak, and then prices will be trending up. As time goes on, your earnings will continue to increase and so on. Inflation would now go down because the steps have been taken to reduce inflation. Interest rates would be down. Think about the last several years. Interest rates have been at historic lows. Inflation at historic lows. Prices going up. So the bull market in that case too is a thriving bull market. Now, my friends, if you think about it, because we still have the residual of the success of the last several years, earnings are still up, but they're going to be trending down. Inflation has shot up, as I'm sure you can tell. Inflation is at historic, going back 40 years, we're not seeing the kind of inflation that we're seeing at this point in time. Interest rates are shooting up, and the Feds are taking steps to increase interest rates. They just raised rates by 75 basis points, which is 0.75% this past week. And prices are still up. In the scenario that we're in now, my friend, the bull market is over. The bull market cannot be sustained in an environment in which earnings are going to be trending down because of the negative effects of inflation, interest rates, and prices. So that's what we've got as far, especially paying attention to that. So now we've got the throngs of a bear market that could be starting and things like that. And this is what I want you to pay attention to. If you've got assets, you've got to be defensive as far as these things go, because we're at the beginning phases. In fact, the NASDAQ is down over 30%. Those of you may or may not know that. S&P 500 and the Dow are down over 20%. That's bear market territory, my friends. So we are essentially in a bear market now. And I point that out so you're cautioned, so that you can exercise caution in whatever you're doing. Next slide, please. So I have to point out that in a bear market, you lose money. And depending on how you manage your assets, you're going to have from small losses to substantial losses. And I point this out because losses are hard to recover. If you understand how losses are recouped, if you lose 10% of your money, you're going to need 11% to get back to even. If you lose 20% of your money, you're going to need 25% to get back to even. If you lose 30%, you're going to need 40+%, 42, 43% to get back to even. I want you to pay attention to that as you manage your assets and your investments as you go forward. Typically, we try to get people to stay in the range of not losing more than 10% of their assets. That's, because essentially you can try to recoup, 10, 11, 12% in relatively short order. Next slide, please. This is the same thing we're talking about. It's really about minimizing risk and avoiding losses as much as possible. Invest in those things that are skewing to the left of this risk capacity gauge. 0%, 10%, you want to be moderate and stuff. You can kind of drift in the direction of maybe 20%, but I would avoid aggressive and over speculative things at this point. Next slide, please. So for all intents and purposes, if you agree with me that the bull market is over, then downside protection is what has to be of paramount importance. If you agree with me that interest rates are rising, then you've got to look at things that would enable you not to lose money in a rising interest rate environment. Bonds lose money when interest rates go up. If you agree with me, my friends, that a bear market is at hand and not just looming, and losses are hard to recover, then you would be thinking capital preservation before capital appreciation. Next slide. So in our portfolio construction, one of the things that we've been able to navigate over the years is what we call the Modern Portfolio Theory Plus, the Canoe Modern Portfolio Theory Plus. We are able to provide clients with combinations of risk where you could, in your portfolio, reduce your risk of loss to zero while optimizing the potential for growth. This is the area that you want to really tilt your assets towards at this point in time. Next slide, please. Today, we're gathered to talk about life insurance. Life insurance as an asset. A lot of people don't have a full appreciation for what life insurance is and how life insurance actually works, and how life insurance actually is the ultimate wealth builder. People think about life insurance they think about it very differently from the way that the very affluent and ultra affluent think about life insurance. They think about it very differently from the way banks think about life insurance. Hopefully, we can unpack a little bit of that this afternoon so you can have some better appreciation for the benefits of life insurance as an asset. Next slide, please. So if you look at this slide, and if you can focus on item number 10 and item number 11. I want to point out that on balance sheets of large financial institutions, many large financial institutions, and many financial institutions, you're going to find that they have in their books assets, life insurance listed as an asset. In this case, if you look at line number 41, life insurance assets is $21 billion. Because the other three, the last three zeros are missing what you're looking at here. 21 billion. Real estate and their bank fixed assets are about 9 billion. So my friends, here's the thing that I'm trying to say to you. You're going to find this as a common theme among a lot of financial institutions. Go to the next slide. Same thing here. 7, 8 billion real estate, 7, 8, 9 billion. Go to the next slide. Okay, the point there is you're going to see that a lot of these institutions have more life insurance in their books than real estate. So if these institutions have more life insurance than real estate, what do they know that most people don't know? That's the question we've got to ask ourselves. If the financial experts are using life insurance the way that they're using them, what is it that they know that we don't know? Well, they know that life insurance as an asset is liquid and accessible. Liquidity means accessibility. They know that life insurance gives them tax-free growth through the way that they access the assets. They know that life insurance gives them better risk-adjusted performance. See, pound for pound, prudence is not in taking risk. Prudence is in avoiding risk. If you can get optimal risk-adjusted performance, then you are really a star. And that's what it's about. They know that life insurance serves as an investment and also protection. They know that you have multiple applications that you can use life insurance for. They know that you can basically, life insurance is something you can get for pennies on the dollar. Next slide, please. So if these large, major financial institutions that you're trusting with your financial know-how and things like that, if they're doing these things with life insurance, why aren't you investing like those institutions? So I would suggest to you that in order for you to build wealth, you need to invest like the big banks. See, life insurance cuts through everything that you do in wealth building. You avoid losses if you invest in life insurance. Life insurance provides you cash flow. Life insurance is a way to invest tax-free and harvest taxes. Life insurance is a way to grow your legacy and grow your assets. So my friends, life insurance is a true wealth building secret. And that's the point that we're trying to get across to you. And I don't know that this message is as clear to people as it should be. Next slide, please. So what I want to do is kind of talk about very briefly, if you look at this spectrum, and some of you may have seen this already before, you can look on the left, everything that you see towards the left and veering to the right, you can see that you've got assets that have the potential to lose money. That's the reason you have the reds going down there. And then the potential for income. If you look at the very last block on the right, it's life insurance. If you look at the very last block on the left, it's alternative investments and so on. Now, the interesting thing is the people who take the most advantage of those two bookends, if you want to call them that, are the accredited investors. But here's the beauty of this. Non-accredited investors can actually take advantage of life insurance and use it to a substantial extent. So keep in mind, if you want to reduce risk, you want to kind of invest in these things that are towards the left. I'm sorry, towards the right. And then if you want to, if you're taking more risk oriented, you'll be kind of skewing towards the other way, where you have the potential for losses. Next slide, please. So if you looked at that continuum, you would see real estate is on there. We call, and the reason I am actually singling out real estate, and I'm going to single out another investment that most of you may not be familiar with. I'm singling out real estate because a significant part of the wealth of this world derives from real estate. Most people, look at real estate in the context of it's a place, for your shelter and stuff like that. But real estate is an incredibly smart investment because it allows you to use leverage. It basically is a possible hedge against inflation. We talked about inflation being something that's rising here. Real estate appreciates, and that income could be tax-free. One of the magics of real estate that people don't have a full appreciation for is the step up in basis at death. What that means, my friends, is this. If you buy a piece of real estate for $1 and you hold it and it appreciates over time, you can exchange that real estate for another real estate, transfer the appreciation, not pay any taxes, into a new piece of property, enjoy a lifestyle plus own the asset, generate income, and then die at some point down the road owning the new asset. And you can do this multiple times in your lifetime. So you can take $1 and through this exchange process and appreciation, you can make that $1 $1 million. And when you die, this step up in basis, that is the phenomenal thing about owning real estate. It's the same thing with most capital assets, by the way. But the basis steps up and the value now becomes $1 million for the $1 that you pay for a piece of real estate. You're not going to pay any, your beneficiaries are not going to pay any taxes on the real estate. You can't beat that. Next slide, please. So the second thing I wanted to talk about, especially in the environment that we're in, is protection from losses. If you recall, I talked about some of the solutions that we have in the Canoe Modern Portfolio Theory Plus and the things that you need to do in this environment. Real estate is something you need to give consideration to. And then looking at how to structure investments using some custom products. There's some structured products that are out there, might be available not to everybody, but there are ways that you can participate that would allow you to protect yourself from losses, participate in gains. And depending on the solution set that we're looking at, we could customize, or you could have these things customized for you. And you could have the banks bidding to provide these solutions for you. These are the kinds of things that we provide some of our clients. Next slide, please. So rising interest rate environment is not a good thing for bonds. And one of the things that we suggest is using structured products and fixed index annuities as an alternative to bonds. If you have bonds for risk reduction, if interest rates are going up, you're going to be losing money, especially if they're long-dated bonds. So understand that and think repositioning of those assets. Next slide, please. Today I'm going to be talking about life insurance or insurance solutions. And some of you may or may not know this. There are different insurance solutions solutions that are in insurance wrappers. Variable annuities are, like mutual funds with an insurance wrapper. Fixed annuities are like certificates of deposits in an insurance wrapper. Fixed index annuities are essentially a combination of mutual funds and fixed products where you don't have losses and so on. Life insurance, the same thing. So you may not know that if you own annuities right now, it's an insurance solution that you have. Same thing with the variable. I just wanted to point that out here. And you can see, because the variable annuities are like mutual funds, you still have the risk of loss. But once you get into the other insurance products, you don't have the risk of loss. There are ways to mitigate the loss in variable annuities because of the insurance wrapper that they're in. Next slide, please. Okay. This is what our meeting today is about. It's about life insurance. So you can see right here that with life insurance, you don't run the risk of losing money. There's principal protection, the risk is low, but the returns are exponential. you can multiply your returns using life insurance. And this is something that people don't have a full appreciation for. Next slide, please. So we have actually crowned life insurance as your ultimate investment. Anybody can argue what they want. But when we look at life insurance, we're looking at life insurance in the context of your risk-adjusted returns. That's the bottom line. In properly structured life insurance solutions, you don't have a risk of loss. And you have the benefit of tax-free growth. You have the benefit of tax-free income. You have the benefit of protection from losses. And you have the benefit of transferring wealth with no tax consequences. Next slide, please. So we talk about life insurance, and then we talk about the types of life insurance. Most people, when they buy life insurance, if I ask this audience, what do you have? Why do you have life, have insurance? They're going to tell me basically that it's to protect their families or to replace whatever, their capacity if they're gone suddenly. Well, my friends, we, in my own universe, we call that death insurance. And the reason we call it death insurance is because the reason you have it is if you died. In that instance, it would be a self-completion vehicle. And most people don't seem to get turned on by the fact that they're spending money on something that is not going to benefit them. And so they tend to make this error of thinking about life insurance in that context. I want you to put as little money as possible into that, in this whole, in their outfit. So, people out there that basically preach buy term and invest the difference. And, unfortunately, from our standpoint, that is one of the worst decisions anybody can make. You're buying death insurance and then you're taking risk. If you remember the investment continuum that I shared with you, the things from the red that have the potential to lose money, you had their stocks, you had mutual funds. People are going to argue all kinds of things about stocks, mutual funds, and the different investments that basically have risk associated with them. And they're also going to tell you this nonsense. I emphasize the word nonsense, that you've got to take more risk to get more return. Listen, my friends, the people who make serious money, they take less risk to get more returns. That's what prudence is about. That's what discernment in investing is about. So buying term and investing the difference is nonsense as far as I'm concerned. And again, I'm using harsh words, but that's me, okay? Forgive me if that's too harsh for you. So you buy death insurance and then you invest the rest and you take whatever risk you want to take. Life insurance, if you begin to understand the magic of life insurance and understand that the cost of insurance is substantially the same, whether you're buying term and investing the difference or buying a permanent policy. If you buy term and invest the difference in whatever it is you're going to invest it in, that underlier is the same underlier that a permanent policy would use, but here's the difference. The difference is, if you remember on the spectrum, everything that's veering to the right, you have no risk of loss. So why would I put $100,000 or whatever the amount of money is, and then take $10,000 and buy something, and then take the other 90,000 and put there in a pot to the left where there's a risk of loss, versus putting it in the pot to the right where you basically have no risk of loss? Those are the kinds of things that you need to be mindful of as far as this goes. So I point out to you that you have to kind of pay attention to that. And going into insurance, that term insurance, by the way, there are two types of term insurance. There's the term insurance, that's the least expensive. By the way, you spend all this money on this term insurance, 20, 30 years, these things go out 30 years, give or take, depending. But you have nothing to show for it, not a thing. If you wanted to renew after 30 years, you end up paying an arm and a leg. By the way, let me say this to you if you don't know this already. More than 90% of term insurance policies do not pay anybody anything. So you're basically pouring water down a crap hole, if you want, because all that money goes. The insurance companies, the bet is that you're not going to, you're not going to basically claim, have the claim. Convertible term is a reasonable next step, because basically you can insure yourself at the place that you are. And what we normally tell people is get insurance as soon as you can. The best time to get insurance, my friends, is yesterday. You know what's interesting is today, and this is happening particularly for us who are first generation Nigerians in the US here. We look and we say, wow, a lot of guys, a lot of females, they wish they knew about these things before now. They wish they knew, because some of us are in our later lives now, and we didn't have the opportunity to capitalize on getting insurance protection and permanence when our medical history or medical records were pretty lean. Next slide, please. So if you get a convertible term policy, you're going to pay a little bit more than you would pay with the term policy that does nothing. But what you're doing is you're holding your medical records at the age that you got the policy. So 10 years later, whatever it is that they allow you as the conversion period, your pricing, you'll be 10 years older, or whatever the number of years is older, but they're using the medical record that they used to give you the term policy. You can't beat that if that is the option you want to pursue. Keep in mind the risk considerations in the alternatives. That's what I would say to you. Let me talk about permanent insurance then. There are different kinds of permanent insurance. There's whole life that basically is, they pay dividends. Whole life invest in bonds and they pay dividends in addition to that. Universal life, they pay, it's a fixed interest product where you get a fixed rate of interest paid to you. Index universal life is tied to the index, an underlying index, where the performance, there's flexibility there and all that kind of stuff. Variable universal life is pretty much like a mutual fund. So the ups and downs there will go as the mutual fund will go. Indexed universal life basically gives you upside potential, flexibility, and no downside capture. The other two, same thing. Whole life and universal life. Next slide, please. So here is the reason we consider life insurance the ultimate investment and why life insurance is an asset. I use the word life. When we talked about term, we use the word death because you're only buying it for death. Most people would be inclined, once they learn more about life insurance and why this is an incredible asset, most people will, like I said, I've had a ton of people say to me, boy, I wish we knew this all this while. I wish we knew this all this while. The thing is, today is the first day of the rest of your life. Life insurance is an asset that will enable you, my friends, to create your own personal bank. Life insurance, my friends, is an asset that will enable you to fund your kids' education. I'm not disqualifying 529 plans, my friends, but let me say this to those of you who may or may not know this. When you go out there and you complete the FAFSA application, everything that you've put in a 529 plan will count towards the FAFSA, whatever the numbers are that where you land. If you had those same assets in a life insurance policy, they would not be included in the calculation of FAFSA. I hope you heard me correctly. So you've got the expanded use of life insurance and the fact that you can actually use this for college education. Oh, by the way, multi-generational tax-free. I'm going to talk about this because of the case study I'm going to share at the back end here. We talk about us being the first generation Nigerians. And first generation Nigerians who are coming into something. And so our kids and grandkids, we want to set them up so that they have the sure-footedness that we didn't have. Life insurance solutions can help with creating multi-generational tax-free cash flow and legacies. Life insurance can help you fund your lifestyle. Life insurance can help you make other investments. Owning real estate, I talked about that. Appreciating assets. So you can take from here, you can bank on yourself. Remember, I said you can create your own personal bank. So rather than going to the bank to borrow money to buy a car or buy a house or buy this, you can use your life insurance, the cash value in your life insurance policy to do all those things. Oh, my friends, life insurance can be also one of your multiple streams of income in your retirement. I will tell you this, we always suggest, because of the incidence of taxes, because if you have $5 million in your 401k today or retirement account, if you're in the 37% tax bracket, do the math. There's that guy called Sam. You guys have paid a ton of money to the US Treasury already. By my count, since the inception of ANPA, you guys have paid over $6 billion in taxes to the US Treasury, Nigerian doctors and dentists, not including all the other Nigerians. I said billion, not million. Let me be clear. So one of the reasons ANPA Foundation has been paired with ANPA itself is to help harvest some of that stuff. But you can use life insurance to fund your retirement. You can use life insurance to do a ton of things that people don't even have a clue about. Next slide, please. Leverage, using life insurance while you're alive. Again, this is why life insurance is an asset. If you have your own bank, why would you go to Citibank to borrow money from them to fund your business? Why would you go to, so here's the thing, you can do some of those things because you can pair those things with the money that you've got, the cash you've built in your life insurance policies. You can use life insurance to transition your business from one partner to another. You can use life insurance as incentives and rewards for key people at your firm. And of course, I've said this multiple times, reduce your taxes. You can use life insurance for. Next slide, please. Again, protecting you, protecting your assets, transferring risk, philanthropy, tax planning, advanced planning strategies, my friends, advanced planning. And then if you were to need to access your cash as a function of the death benefit because you had a critical, chronic, or terminal illness, you can do that. There's nothing else that gives you that kind of access. We're talking about the leverage of protection and the access to that leverage, my friends. Next slide, please. So before I talk about life insurance at death, if you think about everything that I have just chronicled in terms of what you can do with the cash buildup in your life insurance policy, and the fact that you can build up this cash, protecting yourself from losses, minimizing taxes and all that stuff, I think you will agree that life insurance is absolutely and undeniably one of the ultimate investments out there as an asset. So let's talk about life insurance at death. This is what death insurance is about. You're going from here to Chicago with your family and something happens to you, you don't get to Chicago with them, well, they can get to Chicago. That's the way I look at it. Self-completion, what does that mean? You all have death insurance, those who are owning term, because for you, it's if something happened to me, my family would not suffer, those kinds of things. Some people have actually in whatever it is in misguided counsel, I'll say it again, in whatever it is in misguided counsel, have lived a life where they owned life insurance earlier in their lives and felt that because they now had this net worth, that they could get rid of the life insurance. Well, that's the wrong reason to own life insurance, because if you think about life insurance, what you were dealing with was death insurance. You need life insurance for a number of other things, estate planning, all the different things that are there. So I know people who have divested themselves of their life insurance policies, one of the most valuable assets they had, because they felt they had now accumulated enough assets where they didn't need life insurance anymore. Well, too bad. Life insurance or death insurance will give you self-completion. The good news there is you still have the benefit of your tax planning and estate planning, because if you end up using the death insurance, it's because you died too soon. So death insurance is of value if you die too soon. That's the self-completion that I'm talking about. Death insurance will give you the tax planning because your family will receive the money tax-free. And then basically from an estate planning standpoint, if that is the case, whatever the size of your estate is at that point in time, you'll be getting the benefit of that. Next slide. I'm going to give you a few examples real quickly, because this is important. And I want to talk about leverage in life insurance, because people put money in their 401k today, and when they get to know better, they recognize that they can use life insurance even, to a greater advantage. We have a solution where you can basically fund your retirement or your lifestyle for 5 years. And we pair that with a bank loan. So here's an example that I would give. When you buy real estate, or when you bought your home, you put money down, because 100% of the money that you would have put down would only buy you so much home. So you used leverage. You borrowed money from the bank in order to buy a bigger house. What if I told you that you could also do the same thing with your retirement account, that you could actually borrow money from the bank to fund a bigger retirement? What if I told you that the average person is not putting away enough money today to fund their retirement? What if I told you that because of that, most people are working longer than they could have, should have? What if I told you that it's not the investments that you put the money in, but how much money you put in that determine what your income would be down the road? What if I told you those things and I gave you the opportunity to put more money away so you'd have more income down the road? So that instead of putting away $50,000 a year in that, in the 401k, blah, 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 you have the opportunity to put away $250,000 and get it matched with about $750,000 for a bank loan. So now you're investing $1 million instead of $250,000. Again, 75% of your income is going to come from how much money you put to work. And the longer you put it to work, the better off you're going to be. So here's a 40-year-old female. We're going to put her in a situation where she funds her retirement for 5 years. The banks we work with will fund this thing for 10 years. And then after the 15th year, think of this as a 15-year loan you got from the bank. 15th year, you pay the bank back. Next slide, my friend. So here's how it works. Same thing. You can see what's happening here. This is a 40-year-old female. $25,750 for 5 years is what she puts into a $1 million leveraged life insurance policy. For the first 5 years, the bank matches $21,793 of that. And then beginning in year 6, she can do this again 5 years later, or she can now go and put money in her, whatever that thing is, 401k, whatever, blah, blah, blah. Year 6 to year 10, the bank pays 100% of her premiums, $46,193. So you put in 128, the bank puts in almost $140,000, my friends. Total contributions. So if you were doing this alone, you put in 128,000. With the leverage that we've just added, you're putting in almost $500,000 working for you. Next slide, please. Here's the result when you do it yourself. Here's your $25,000 for 5 years. Your age, this is a 40-year-old female, remember? At age 65, they will be getting $36,000 a year. And essentially $900,000 in potential distributions. If they're used leverage, they could get as much as $73,000 a year. Do you see the light blue next to that? I hope you do. Now look at the multiplier effect that you have as far as all of these are concerned. Oh, by the way, you've got a death benefit of $200,000 at age 90 in the other instance, almost $600,000 in the other instance. And here's the thing, by the way, interest rates are going up right now. We don't know if we're going to have a depression or a recession. You do this yourself, you might not have any money to do any of this stuff in stress testing situations. Doesn't mean you're not going to have anything at all. But look at this. In a rising interest rate environment, we simulated this thing in the 1980s interest rate environment. Remember the Jimmy Carter years? You're still able to pull $50,000. Here's my question. I normally ask everybody this question. If you give me $25,000 a year for 5 years, and I give you $25,000 a year for 26 years tax-free, will you take that? So forget the 55 that's stress tested. Forget the 47 that's stress tested. 25, you give me 25 for 5, I give you 25 for 26. Maybe there's going to be somebody new on this in this crowd that's going to say that's not a good bet for me. But I'll tell you this, and as many times as I've asked this question, there's not a single person has said, I will not take that bet. So my friends, if you accept 25 for 25 for 26, 25 for 5 and 25 for 26, imagine everything else is gravy, my friends. That's even less than the stress tested numbers we have here. Next slide, please. So this is what we're talking about. I think I kind of summarized it. You've seen column C and D, column B and C, I'm sorry. And you see where you're paying off, the red line is where you're paying off the loan for the 40-year-old. So scroll down, just scroll, my friend. So you can see the summary right there. Would you invest $25,000 for 5 to get 25? That's the question I'm asking, because I'm not even dealing with it, $73,000. If 25 for 25, 25 for 5 in exchange for 25 for 26 tax-free. By the way, I want to stress tax-free. If that makes sense to you, then everything else is gravy. The illustration you're looking at here is 73,000. I'm not even going that far. That's 3 times essentially what I am saying most people would accept for 26 years. And by the way, scroll, please, scroll. Because I want to get to the bottom of this and show you what you get as a death benefit after receiving this income. You get almost $600,000 if you died at 90. If you happen to live to 100, and most people these days could live to 100, 200, whatever it is, you're talking about well in excess of $2 million, a couple of $1 million, depending on performance again. Next slide, go to the next slide. Let me show you a 50-year-old male, same situation. Fact pattern is the same. Go on to the next thing. Okay, $40,000 a year for 5 years will give you basically, and you match that stuff. You've got $200,000 total contribution, $700,000. The bank loans you $500,000. Next slide. Case pattern is the same. Question I would ask is, if you go on to the next, it's the same thing as what I just showed you earlier. Go to the next slide. What I would ask you is this: would you give me $40,000 a year for 5 if I give you $25,000 a year for 26 years? So I'm beating this thing down because it makes so much sense. Remember what I said. What I said is this: it's not your $250,000, it's the $1 million that's working for you that matters. That's the reason you're able to manufacture $50,000 a year of tax-free income, or even 40,000 or 25,000. It's how much you have working for you. If you borrow that amount, the same thing you're doing with your real estate, it's magical. You're creating another source of income. Next slide, I want to talk about the one that has become my passion. Same thing here, death benefit of $500,000. You've collected all this income. You've got $500,000 of death benefit after receiving all this income. And again, this is one source of income. And then you've got whatever it is that you end up with as a death benefit in addition to all the income you've got. Nothing, my friends, there's nothing out there that basically comes close. This is what I want to end on because, see, I have developed a passion and a mission. I talked about us as the first generation. And beyond my first mission of educating physicians about financial intelligence and savvy, this has become the one thing for me that I am hell-bent on seeing come to fruition. You know, I'll tell you an affirmation that I have every day. This is my affirmation. The amount of money that I make is nothing compared to the impact that I will make in the lives of people, our Nigerians and mankind. I want to say it again. The impact of this on our financial lives is a multiplier. So here's the question. Those of us who are in the generation that are saying, I wish I had known this before. So now you know. Would you provide your kids, what would you rather give your kids? $250,000 in cash when you die or whatever it is, or $2 million approximately of a stream of tax-free lifetime income? You may not understand this question, but this is what planting the seeds for multi-generational legacy planning is about. If you don't understand this and you're not using leverage yourself, well, hopefully at least you're getting informed. If you don't understand this, I would encourage you to take the time to understand how leverage works to support you, because you can use leverage in so many ways. It's what you're using for real estate to buy real estate. Why can't you use it to create a lifestyle, to create a multi-generational legacy and all that kind of stuff? So here's the example, 4 kids. This is whoever. If you have 4 kids, that's what you got. You got a 29-year-old, female, and you're gonna pay $20,000 a year for 5 years. So they're gonna contribute basically, $20,000 a year for 5 years. Same family, they've got a son, 27 years old, $22,000 a year. Men have to suffer more. This is kind of the way it is. They die earlier, and then they cost more in life insurance wise. And then you got twin kids here, a boy and a girl, 25. So again, depending on how many kids you have, you're looking at this family here. 20,000 plus 22 plus 21 plus 18. If you notice something, the male and the female, the amounts are different. Now I want you to go to the far right, because this is where your 20,000 and 22 and 21 and 18 add up to create 108, 139, 150, 130. That's the cash flow that could be created by you're putting away this money for 5 years. Remember what we went through in the earlier illustrations. Would you give me 25,000 for 5 to get 25,000 for 26? What we're talking about here is the same thing. You can do the same math any way you want, but you're building this incredible legacy. Go to the next slide, my friend. So here's the summary of this thing. The 4 kids that this family has, the parents, or even the kids, if you make $100,000 a year, which I imagine everybody here does in their sleep, $82,000 for the family. If you make $100,000 a year, you can get into this program. what we can, it requires financial underwriting. The financial underwriting is $100,000 of income the last couple of years, and the fact that you're going to basically be able to do that, plus be able to afford this, okay? But this family, $82,000 a year for 5 years. That's what they're going to put out. Again, depending on how many kids you have. If you have more than 4, then and you want to do this for all of them and all that kind of stuff. But here's what you've got. $82,000 a year could provide up to $500,000, $529,000 in annual tax-free income. I didn't do this intentionally. Remember the 529 plan? $529,000 a year in annual, up to $529,000 in tax-free income and cash flow for more than 26 years. Hey, look at the second paragraph. Investing $413,000 total. This is money you could move out of your estate, doctor, and transfer it to your kids. Transfer $413,000 to your kids, and guess what you've done? You've set them up to receive almost $14 million of tax-free cash flow in their lifetime. Plus, each of them would have a death benefit of $1 million plus. That's paragraph number 2. For everybody, it's different because I don't know how many kids you have. I don't know their ages and all those kinds of things. They have to be over 18 for us to be able to use leverage, by the way. But this is the kind of stuff we're talking about now. Imagine this. We all came to this country with nothing for the most part. But by God's grace, we have accomplished what we have. Think about the foundation you're setting for your kids, and that's the 3rd paragraph here. These kids can access this and make it their own bank to create their own legacy, multi-generational. They can borrow for their personal needs, home, auto, business for their kids. So you're now providing for your own grandkids and things like that. And guess what? This is rather than borrowing from the bank. You compare those two things to create even additional leverage. So my friends, I rest. Questions?
Enyi, thank you very much for a very exciting presentation on life insurance. And there's some clapping. Thank you again for giving us this wonderful information. I have received some questions for you. One of the questions is actually on your last slide about borrowing from the bank that you created. Question is, why are you borrowing money from yourself? Why, if it's truly your money, why borrow money and pay interest?
That's an excellent question. That's an excellent question because you want leverage. Here's what would happen. You've built, everybody has some savings. Everybody has some money that they've saved. Here's one thing, by the way, and I didn't talk about that. Okay, some of you may be familiar with the fact that, the business owners that we work with and we get them, you can put money into an account, an insurance savings account, and access that money within 30 days to do whatever you want to do. And you have life insurance in addition to that. Infinite banking is what some people call it. Okay, we call it being your own bank. Because what will happen is this, the money you borrow, okay, from this whole thing, it's actually being paired with money the money that you put into this thing, your money is still working 100%. So you're borrowing from it is like you're owning real estate and using the equity in the home, but the home is still appreciating in value. So what you put in originally will get the performance of the underlying investment. And what you borrow is, you're going to pay interest on it, but that interest essentially is going to be, most of the time it's less than what the performance of the investment is. I hope I'm answering the question, because you're borrowing from yourself in order to basically kind of multiply your capability. In the meantime, the money you put in is still working like you didn't borrow from it. Hopefully this is even better.
So the follow-up question was that, so you borrow this money and you have to service the loan, you have to pay it back, right? Well, what if you don't pay
Yes,
it back?
you have to, you don't have to, is the reality. But here's the point in this. You borrow the money, you don't have to pay it back, but the money that you borrowed has nothing to do with your investment itself, because that's what we call indirect recognition. If you borrow money, if you have a piece of property and you take out a home equity line of credit, okay, you can pay the home equity line of credit and all that kind of stuff. Your home is still appreciating in value. So if your home is worth $1 million and you borrowed $500,000 from it, you're paying interest on $500,000. The home that's worth $1 million is appreciating at $1 million. So if you borrowed at 5% and your home was appreciating at 5%, 5% of $1 million is 50,000. Am I right?
Mm-hmm.
Please nod your head, Stanley.
Yes.
Am I right?
Yes.
Okay. And what is 5% of 500,000? 25,000.
25,000.
Yeah. So you own this asset that's valued at $1 million that grew at 5% and gave you $50,000, right? $50,000 of growth. And then you owe $500,000 that you may be putting cash flow in to reduce. But if you don't, you borrowed it at 5%. So 5% of 500,000 is 25,000. You made 50,000. You paid $25,000 in interest. You still made money, didn't you?
Yes. So I have another question for you. Is feel free to send your question by chat. You can speak if you want. You have to unmute yourself to speak. But some people send you questions on private chat. What if my employer offers me life insurance? Do I still need to get my own life insurance?
Absolutely. I'm going to basically just blatantly say absolutely. Your employer life insurance has nothing to do with this. We're talking about saving. This is life insurance as an investment. Let's understand that. Life insurance, the typical employer offers you group insurance and stuff like that. And that's a totally different thing. Now, there are business owners that for key people and so on, we have solutions where we can use this to retain. If you remember when I talked about use of life insurance and stuff, there are many different uses of it. But your typical employer would give you, they're mostly term policies and group policies like that. And yes, you can afford those things. And yeah, there's some universal policies that you may get from your employer and so on. But what we're talking about here is leveraged life insurance.
Okay. There's a question on the chat to everyone. Are there any downsides to this whole life insurance? How do we set it up?
Permanent insurance. Okay, let me, how do we set it up? We can help if you would trust us with that. Basically what happens is we'll need your financials, tax returns. We'll need you to complete the application and things like that. And then there's financial underwriting and then there's medical underwriting. But the simple point, it's simply this: if you can afford to do it yesterday, because you're healthier yesterday, or today, as the case may be, you're as healthy as you're going to be today, hopefully, and as young as you're going to be today. If you can basically kind of do those things, then you really want to do this. You want to take advantage of the bank loaning you money to fund lifestyle, to fund everything. You're going to have to keep the loan for 15 years. That's it.
There's another question is, how do I set this up for my kids? I'm assuming the person's referring to the multi-generational planning that you're talking about.
Absolutely. Again, talk to us. You can reach out to us on the 513-769-2700. And again, this is interesting because I'm hearing how questions, and maybe we need to reset our thinking to who can help us get this done. The how part is where we do gather the paperwork, do the underwrite, get the underwriting and all that stuff, and then help with making those things happen. So hopefully that's answering the how question for you. If you reach out to us, my office will send you the invitation depending on the ages of your kids and so on. Remember, the kids have got to be over 18 to be able to use leverage. And depending on your age, we typically like to see you involved in using leverage also.
Okay, there's another question. Can these policies be purchased as a corporate or trust entity?
Absolutely. As a matter of fact, these things are done in trusts. And yes, we have company plans that basically do this for many different reasons. I actually talked about it in the when I was in my slides, using life insurance, for businesses and things like that. The answer is yes.
Okay, so you can have, if you own your own business, you can do that.
Yes, we can have that conversation. Absolutely.
Okay. Does anybody have any other questions for Enyi? You can speak up or mute yourself to speak, or send a question.
Yeah, sorry, I have a question. So just to follow up to
Please,
what was asked.
identify your name. Who's speaking?
Oh, sorry, Dr. Uzi. I'm the chair. I'm the Middle Tennessee chair.
Hey, Dr. Uzi.
Hey, how are you?
Welcome.
Good, thank you, sir. Right. So the question I'm asking, for example, I mean, it's a follow-up to what was asked earlier on. I have a company, like two different companies, and one of them, if I decide to start investing for my kids, I have two kids. One of them is 17, the other one is 16. I know I have to wait until they turn 18. So when I do this type of investments, life insurance, so in the kids from the company, whatever I contribute will be tax deductible?
Every case is different, my friend. First of all, as I'm listening to you, do your kids work for your company?
Yes, I pay them $10.99. Yeah.
You pay them a $10.99. Okay. So the kids work for the company. Well,
Yes.
Good. Congratulations, because some people don't even understand that as a tax shifting strategy. That's the reason I asked the question. But there are ways that these things can be structured. I can't kind of deconstruct any case without really kind of getting more information and enough information. And that may be something that would require the input of our tax planning experts and things like that. Is that helpful?
Okay, yeah, that's helpful. Thank you.
There's a bunch of questions coming. Is it transferable while you're alive? I guess, what does that mean? Is it transferable? Like, are you asking if the life insurance is transferable, or maybe can the person feel free to ask the question live?
Yes.
Okay.
My question is the whole life policy transferable?
Can you identify yourself briefly, if that's okay?
Yeah, that's my question.
Okay, so let me share. Let me say something here. When you say transferable, what is the intent of transferring a policy?
So, for instance, if you are, if you lose some sort of cognitive ability, right, to continue to contribute to the fund, and let's say just by a living will, you're able to transfer it to your power of attorney. Is that possible?
Are you talking about transferring the ownership?
Transferring the rights and the decision-making around it.
So, well, there are no decisions to make. You're talking about transferring the ownership. You can transfer ownership to anybody you want. The insured is not going to change. Does that answer your question?
Yeah, so it's transferable, right?
Yeah, you can transfer ownership. Yeah, that's a non-issue. That's not, once, if you're using leverage, ownership is totally different from the person who's insured.
No, we're not talking about the benefactors of the life insurance. We're talking about.
Go ahead.
We're talking about the owner, like the person who owns and purchased the whole life insurance. If are there certain what's it called? situations where you can actually elect to transfer it to a power of attorney?
You can transfer ownership. That's what I'm saying. If you're talking ownership, you can transfer ownership. Look, people use some of these solutions, okay, as part of building wealth in their business. They use it as part of, it actually helps in selling your business and stuff like that if you structure these things properly. So that somebody who's coming in to buy a business, there are many different ways that these things can be used. So the transfer of ownership is not an issue. What you cannot do is you cannot take you who is the insured, you can't transfer it to somebody else.
Right,
you can
right.
transfer the ownership.
Okay.
Does that make sense?
Yep.
Am I answering your question though?
You did. Thank you.
Yeah,
Okay.
I may share that. We are going through this process now with Enyi with my kids, so I have understanding of this. But particularly, Enyi, can you kind of highlight two things? One is, I want those people that have kids that are going to college. One,
I'm
mentioned
sorry,
it, but
Stanley, I didn't hear you. Somebody is shuffling something, and that's
okay. Let me mute the person. Okay. Can you highlight two things for me? One is, a lot of our colleagues have kids that are going to college in the future. I think some people came in late about FAFSA and how to use life insurance leverage to pay for college. Number one. Number two is also talk about how to highlight the business aspect of it. How do you use it to sell your practice or whatever? Can you just talk about those? Because I know we're out of time.
Yeah, I mean, your company can own the asset. If it's on your company's balance sheet, it's an asset that essentially, again, it's on your life. You don't transfer the life itself, but if there's cash value in that, you're talking about the business aspect of this, the business case for helping fortify your balance sheet. You remember we talked about bank balance sheets. Bank balance sheets have life insurance in them. Same thing. Banks are businesses too. Is that helpful?
Yes, yes. Now, just talk about the last note was about college funds. How do you use? Is it possible to use life insurance to? I think you talked about it. I'm looking for.
Absolutely.
Oh, right here.
If you've got, I mean, look, 529s are terrific investment solutions. You have to go to college. If the kid doesn't go to college, it has to go to the next kid in the same family and stuff like that. Otherwise, you don't get the full benefits of all that stuff. With life insurance, there's complete flexibility. Complete flexibility. You don't need to go to college to use it. You can use it for whatever you want. If you have young kids, you don't have to use leverage to do this for the young kids. Just get started, put the money in there, and put as much as you can to fund. You've got a death benefit, but that's not the reason for this. The reason for this is the tax-free income down the road. And then if you start early and use it, then you can use it, like I said, for college, the same way you would use 529 funds. But now you're not tied to the kid having to go to college. And if they don't go to college, you have to kind of transfer it to the next kid and use it for all that kind of stuff. You're not tied to the same covenants as you would be.
All right. I have last question here is somebody said that they had difficulty getting cash value when, I don't know what kind of insurance that they had. They had life insurance and it built cash value. And when they wanted to access the cash value, they had a problem paying interest and it was difficult. How difficult it is to get cash out of your cash value life insurance?
I just told you a moment ago. Sorry. I just told you a moment ago that, there are programs out there that would allow you to access your cash, 30, 60 days after you put the cash in there. The money is still going to be working for you. You can use the money to do other things that you want to do. That's one. I suspect that the experience the person has had, and I'll tell you this, we run into that older policies, older universal life policies and things like that, where, and I don't know if this is exactly what they're talking about, but I'm going to give you scenarios where we have rescued some of these policies. We've had cases where people have borrowed the money, and because they had these old policies where the interest rate was like 8%, 9%, all that kind of stuff to borrow, and you would capitalize the interest. You don't get, basically what happens is that you're capitalizing the interest, it's kind of eating away at all the stuff. Most of the policies today, the newer policies, you've got a couple of options. You definitely, the liquidity part of it is an imperative. Okay, you might have a straight policy where your cost of money is 1%, give or take. Or if you want to kind of let it float with the market, then it floats with the market and stuff like that. When I say float with the market, I'm talking about the market performance and all that kind of stuff. I don't know if I'm explaining this as well as I could, but in the older policies, there were issues from time to time, depending on how much was borrowed. I know some people who borrowed a lot of money from those things to do different things. They didn't pay anything back, but at 8%, they were basically being charged 8% when they were being credited 4.5%. So they were upside down.
They're being charged more than what is being earned.
Credited. They were being charged more than what they were being credited, exactly. And typically the structure that we would support would be the other way around.
Okay.
And so we've had situations where we rescued a number of those, with a number of people and so on. And I don't think I'm answering his question about him having difficulty accessing whatever his cash is or was. I don't know if you still have that situation. I will be happy to have the conversation with you to kind of look at this a little bit more if you want. So that's the offer I'll make to you. If you want us to look at your situation and understand why you have had difficulty accessing the cash, we'll be happy to do that. Just call the office 513-769-2700.
And I see, based on this, you do offer a second opinion review for people.
Absolutely.
Okay, there's one last question. Is this asset federally insured?
These are insurance assets. The reason I'm laughing is because this is an insurance product, and the insurance products are not federally insured, but they are supported by the financial capabilities of the insurance companies that you're buying the insurance from. So, and part of our fiduciary responsibility is to make sure we're not putting you into, companies that have a risk of failure.
Well,
I hope that answers that question.
Yes, anyway, thank you very much for a wonderful presentation. I want to use the opportunity to announce that, just to remind everyone about the upcoming national convention in the next week in Charlotte, North Carolina. And I want to selfishly say that the ANPA Foundation will be there, part of a sponsor, and Enyi, you'll be there as well. You promise?
Oh, I'll be there.
Okay, and please come to the ANPA Foundation board, chair or table booth to get more information about ANPA Foundation. We are launching it, and most of this stuff will be discussed. I hope everybody have a wonderful Father's Day tomorrow. If you're a father or father-to-be, I wish everybody a happy Father's Day. Enjoy your weekend. This presentation is being recorded. We will post the recording later in all the ANPA channels. Everyone have a wonderful weekend. Thank you very much. Appreciate another wonderful meeting.